In this video, traders, we're going to look at a trade review for a trade I didn't actually take, not because it wasn't technically sound, the risk order ratio just didn't add up for me. So I let it go. It happened to have worked out, but that's the way it is. Let's review it. Let's have a look. Stay tuned. Hey traders, warm welcome to you. All right, so let's have a look at a trade that I was looking out for, a trade that I was wanting to take. Technically very, very nice. We'll run through all the parameters around the trade, but in actual fact, it just didn't work out. It just wasn't, the risk order ratio was just wrong for me, and it has to tick every single box. Even if one is missed, for me that risk order ratio, the stop level is so important. So let's hit the screens and let's have a look. All right guys, so here we are in PayPal. This is the stock I was watching. We pulled back quite a lot on a lot of the markets, especially the NASDAQ, from this 26th of May, 27th of May. But regardless of that, let's look at the overall picture here. Overall picture is one of strength. Good, strong stock, gapped above highs after the COVID dip with earnings. Lovely, lovely, lovely type of trade. If you're hanging around and you're subscribing, you've seen other trades, other videos, I talk about a trade review I did, a very similar trade on Peloton. I talk about some other trades I did, on some other stocks on Datadog. The same kind of setup. So it's a nice setup. It's working very well at the moment. So I'm going to put some risk capital into these kind of trades. Anyway, one thing that I have to have, and one thing I talk about a lot, and again, this is my process, guys. This is how I do things. Hopefully you can take one or two things from it, pick and choose what works for you and create your own process. So gap up, strong stock, holding, a big pullback in the NASDAQ, causing a bit of a pullback in some of these strong stocks on my strong stock list. Outside day there, that's not a good sign, but this is a good sign. In fact, we pull back to this 140 support on this day here. Let's get the drawing pen out. Pull back to this 140 support. And then, we kind of we rallied back up and closed here. Now I'm all over these normally. I love this stuff. It's a strong market, it's flagging, it's only just come off highs only because the broader market is very, very weak at that point in time. We'd seen a rally across the market. We've seen this rally strong off the lows. If you look at a 15-minute chart, let's get rid of this. You can see, look at a strong rally off the lows, ripping straight through the VWAP, holding at highs. Really, really, really great trade. One of the ones that I will take all day, every day at the close or an afternoon breakout type trade. So why didn't I take this trade? Well, the risk order ratio, guys, just wasn't there. And let me show you why. So it's textbook, it's got the strength, it's got the gap, it's got every single box tick that I like on a daily. It's even got the intraday trigger of the push to lows, the intraday reversal. We'll talk about that intraday reversal type thing. And that's there, or midday reversal type thing. And that's there. It's almost to the letter. However, for a swing trade, when we're closing here, I'm looking at the risk on the deal. Where's the risk on the deal? Where do you think the risk is on this deal? Pause it if you like, whatever. The risk on the deal has got to be under that low. It's got to be under the 140. You can't have it anywhere else logically. So I'm talking 139, 138.50, something like that. And where's the close? We've closed at 146, give or take. So I've got $7 worth of risk. So for me to take this trade, I'm going to need at least $20, call it 14. 2 to 1, I'll take those if the setup's good, and it was a great setup. Don't get me wrong, this is such a beautiful technical setup. I love these type of things, but I've got to have $14 worth of target. I've got to. I can't take a trade that hasn't really got at least that. Now, will I always end up taking 2 to 1? No. Some of the video reviews I've done, you can see sometimes the market just changes its phase, and you go, right, well, I've got some profit. I'll take some off the table. I'll look to run some. I'll get stopped. Okay, well, I ultimately only got 1.5 times my risk. It happens, but you've got to have that in your mind at least. So if I'm taking this on the close at where's the close at 146, I've got to look for a much higher move. I've got to be looking at 160 really. And is that feasible? It is, and we may well tag that. The way this is so strong, I don't doubt that we might tag that at some point. However, my initial target's got to be the high, which is 154, so it doesn't really give me enough. The risk order ratio is not quite enough. It's almost there, but it's not quite, guys. The risk was too much, and I felt that it rallied too much. Now, interestingly, if it hadn't have rallied so hard and it still kind of closed at maybe 143, $3 lower, it changes the dynamic completely. All of a sudden, it's $4 worth of risk. I need just $8 to make it work, which going back up would easily make it work then. You know, so sometimes you have to take the trade that's in front of you. You have to wrap your parameters, your stop, your targets around the pattern that it's given to you. And sometimes that pattern is so strong that it ruins the risk reward ratio. Your options are you take it and have a stop what suits you. I don't like doing that because you're not trading to the chart, you're trading to what you want the market to do. You're trying to force what you want it to do. Oh, market, don't go under 142. It's like, well, I've been 142 lows. Why is that a meaningful level? Well, it's not. It's a level you're trying to impose on it. It has to be under that 140 because the thesis of the trade is we're strong, reversed off lows, we've closed at highs, we're going to now have a 3-day run. That's the thesis of the trade. The other option is that you go, well, actually, is my target can be extended? And I don't mind that. You know, that's feasible. If you said to me, Mark, listen, you know, we've got to have a $7 stop on this. But however, you know, I think we can easily run to 160 on this stock, purely because of the brackets we're doing. You know, we're doing $10 runs. You can see $10 here, $10 kind of sees the chunk, $10 or $12. You know, we could easily run from that. And kind of pause a little bit and push on. And I said, okay, allocate a little bit of capital to it. Let's not go crazy, but allocate a bit of capital. And maybe, obviously, hindsight would be the right thing to do because we'd be up here, you know, we'd have a $10 trade or $10 profit in the bag at the moment, looking for the move to 160, closing at all-time highs. In fact, what's it looking at today? 154. So it's opening flat, but you know, you drag your stop up and you run this and you see where it goes. But that's by the by. You know, the idea is, guys, that I like to. At the moment, the market is very volatile. There's a lot of opportunity. Excuse me. And so, you know, I can pick and choose. And if the risk reward ratio isn't that great, it's not that great. If you go back and look at the review I did on Peloton, the risk reward ratio was beautiful. It was like 3-1, 4-1, something like that. And with sensible levels, same kind of thing. Pushing lower, giving me a break. It wasn't quite the same kind of thing, but a similar setup. We broke through the low, pushed back up. It gave a nice frame trade. It means that the thesis is matching the actual stop loss that you are using with the trade, which has to match. So one that got away potentially, doesn't matter. I'll keep screening for these. These are nice trades to take, buying strong stocks when you get some kind of trigger after a pullback, selling weak stocks after some sort of trigger and a pullback. It works really well. So that's it, guys. Keep your risk managed, take care, and I'll see you in the next video. Don't forget to check out channel sponsor, link to them in the description below. Bye bye.